And when Apple stock opens today, the company's market cap should fall over $40 billion, more than the value of Nokia, Dell, and Research in Motion combined. What's happening to the company? Some thought invulnerable just a year ago. John Shinal of MarketWatch joins us. John, thanks so much.
Yeah, you're welcome, Ralph. I appreciate the wake-up call.
So, and Apple shareholders got one too. So the numbers didn't seem that terrible from the quarterly report. Why the huge move down for the stock?
Well, here's what happened. The iPhone unit shipments were up 29%, and iPad shipments up 49%, but sales only rose 18%. And Apple's gross margin went down somewhere in the neighborhood of 600 basis points year over year to roughly 39% of revenue from 45%. So you have to ask yourself what's happening to Apple's pricing power. Mm-hmm. And I think it's pretty clear that either the carriers, the phone carriers, are having to cut subsidies to Apple or cut prices, or they're sharing less of the subsidy to Apple. One quick thing, their sales were up $8 billion year over year. Only $300 million of that went through the gross margin line. So the exclusive pricing power is pretty much, looks like it's gone.
And yet, one interesting thing, John, is that one thing I noticed is if you actually look at the average sales price of iPhones, they actually went up in the quarter, which is pretty interesting. But I do want to, one of the interesting things out of your column is is the Apple-Google fight right now in smartphones a repeat of what we saw in PCs in the 80s between Apple and Microsoft?
I would say that until Google bought Motorola, it was an exact repeat because you had Apple developing both hardware and software for a computing market, in this case the mobile computing market. Back in the 80s, Microsoft focused on software, Apple did hardware and software. The Microsoft ecosystem, if you will, really marginalized Apple, made them a niche player. But now Google has been developing Android software, giving it away for free. Apple's developing iPhones, the software and the hardware. And now it looks like, with Samsung and these other Android handset makers gaining market share, that Apple doesn't have quite the, that people aren't willing to pay as much. Now, the sales price might be up, but what they get from the carriers and what the carriers have to, what kind of promotions they have to run, that influences how much of the money goes back to Apple. Like the iPhone I bought, I waited until AT&T had a promotion, got it for $49. I didn't need to have Siri or Apple Maps and the latest thing on it. And I think a lot of handset shoppers are willing to wait and not pay extra for the premium that even just a year ago, as you said, the iPhone used to command.
Mm-hmm. Okay, now why is it that Google, in the long run, or do you think that is Google, I should say, in a better position in the long run in your view?
I really do, only because if you look at the market share numbers, both in the U.S. and globally, the Android phones have been picking up, even though Apple's growing, don't get me wrong, like I said, 29%, the Android market is growing faster. And when you have more revenue growth, you're going to have more innovation, ultimately. And the one thing that's interesting is Apple was talking about China. But if Apple is losing customers, or losing market share, in high-margin markets like the U.S. and Europe, they would have to gain a lot of new customers in developing markets like China just to make up the difference. And clearly, with the other thing about the gross margin, it went down about 600 basis points, but they forecast it to go down even more in the first quarter. So I think a lot of maybe growth investors are really concerned, that the fast growth days of Apple, at least right now, the trajectory might be flattening out a little.
That's an interesting point. You wonder if maybe some of what's happening here is just a turnover in the investor base. Maybe all the growth investors that thought this growth story was going to continue for a long time are fleeing, and maybe what you'll see is it'll start to be a true value stock. Do you see that happening?
I really do think that it's possible. Given their cash position, value investors and the PE, which is low if you look at the cash, and of course income investors, now that they're paying a dividend, that's a very tricky thing for a tech company. Once they start paying a dividend, in a way it's an acknowledgement that they've got a lot of cash that they haven't been able to invest to grow, so they give it back to shareholders. So I don't think that growth, if a growth manager looks at this company and sees that the sales growth is decelerating, I think that's maybe why we saw the stock go from 700 to 500 in 4 months, and why it was 10% down in aftermarket yesterday after the earnings.
Okay. John Shinal from MarketWatch, thanks so much for joining us.